So let's take the conversation forward. Manishi Raychaudhuri, CEO of Emmer Capital Partners, is with us. Manishi, great to have you on. Thanks for joining in. So, you know, GST bonanza, income tax cuts, RBI cuts, all of it is coming together to really lift sentiment in the market. And the market's also responding. The question is, can it really translate into better earnings? Where are you, Manishi, on the earnings estimates for this year after Q1 and after the range of policy announcements that have, that have just taken place?
Thank you very much for having me, Subhi, and a very good morning to your viewers. First of all, the earnings environment in India for the past year, right from September 2024, has been quite bleak. We have seen consistent earnings estimate downgrades over the past year. And it hasn't stopped over the last 2 quarters. So one will have to watch very keenly the result reporting season for this July-September quarter, which will be across October and November. I have a feeling that this might turn out to be the worst quarter before we have a certain degree of bottoming out of earnings estimates and a gradual recovery in the beginning of next year, in the beginning of 2026. The reason why I'm saying this is, number one, there's a lot of fiscal and monetary stimulus that has gone in. If you look at the latest GST cut, that is something around 0.5 to 0.6% of GDP. We have had the jumbo rate cut earlier, and RBI, believe me, has a lot of dry powder. Today, the real policy rates are close to 4%. It's only been twice as high as this over the last decade. So RBI, even though they have cut by about 100 basis points, they can cut potentially by maybe another 50 to 100 basis points spread over the next 6 to 12 months. So, number one, we have had a lot of fiscal and monetary stimulus. There's room for more monetary stimulus. At some point of time, this would have an effect on the domestic consumption and investment environment. We're already anecdotally seeing that. There are the signs of demand recovery in automobiles, for example. We have seen some companies cutting prices even earlier than the September 22nd deadline. So, I think we will have to watch out very keenly for September, for the September quarter results to come out across October, November. But beyond that, I think there's a case for earnings estimates bottoming out and beginning to revive.
So Q2 should be the bottom, and Q3 onwards, things should start on an uptrend. Manishi, hi, morning. When we last spoke, you said you were completely avoiding IT and I think consumer staples. We'll get to IT, but first on consumer staples. Is there a case for a buy on consumer staples FMCG post the GST cuts?
Well, there would be some benefits, no doubt, to that sector. But at the same time, look at it this way, that consumer staples are well penetrated across India. And that is why, for years and years, the leading consumer staples companies are reporting top-line growth in the mid-single digits. At the same time, they trade somewhere between 40 to 60 times P multiples going forward. So, in a nutshell, a single sentence answer to your question would be no. Despite this GST cut, I'm still not enthused about the consumer staples universe.
All right. Hi, Manishi. Good to see you, Ben. Manishi, the theme that has a longer runaway has to be some of the stock market plays. The problem is, in the last 24 months, they ran so hard that they've all come in for profit taking. Case in point being the exchange that's listed, that's BSE. From more than 3,000 rupees, it's closer to 2,000 rupees. You have Angel One, another stock, that was up, I think, around close to 3,500, 4,000 rupees. It's having around the 2,000, 2,200 rupee odd mark. What is your view on this capital market place? For a longer term investor, it could probably make sense. Would you believe so? But the near term, that could be a lot of pain. Your take?
Great. Thank you for that question. Very interesting. And even before I answer that question, Nigel, let me wish you a very happy birthday.
Thank you so much, Manishi.
So, looking at that capital market universe, you see, there are a few different segments over there. Number one, you have the wealth managers you have the likes of, Angel One, Nuvama, who are targeting the retail clients, very high net worth clients. You have exchanges, which basically have to depend on trading volumes and IPO volumes. And these exchanges are also much more regulated. They're also much more, if I may use that word, slave to the regulations which keep changing. So, for example, I mean, if you have the same expiry date across, all exchanges, obviously that has an impact on the trading volumes in the derivatives segment. So, I, for one, am more bullish on the wealth managers. Some of them are, despite the fact that they have run up, are still trading at reasonable valuations. Many of them have had earnings estimates being, taken up over the last 6 months to 1 year. So one has to tread carefully in this segment. It is a good choice for India, which is likely going to have a capital market boom over the next decade. But one has to be a little careful in his choice, in his top choice over here.
So Manishi, what are you most bullish on now at this juncture? You like wealth management, but what else?
I still like, and I may be sounding like a broken record here, I still like the private sector banks. India's 10 to 12% GDP growth would have to be financed largely by the private sector banks. Yes, the public sector banks would play a role, but the private sector banks would obviously gain a lot of market share over the next few decades. Their asset quality is way better than the public sector banks. Their valuations, look at HDFC Bank, which used to be at 4 times price to book. It has now come down to somewhere close to 2 to 2.2 times. So that is, really front and center of my sector choice. I also like consumer discretionary. Again, one has to be a bit selective about valuations here. I do like the four-wheelers, automobiles over there, and certain segments within the consumer discretionaries. I would include the health, chains. The domestic healthcare chains like the hospitals and the diagnostic chains in here. I also like the industrials selectively, including the defense names, which have run up to sharp and valuation support may not exist there. But a combination of government infrastructure investments and potential revival of private sector capex would have a tailwind on that sector eventually.
Manishi, I just want to come back to that point that you made on consumption. You said you're not quite convinced and you're not sort of jumping from the rooftops with that theme. Just expand on that. Does that call only apply to, say, pure FMCG staples, or do you mean across the board? And if you are not too enthused with these GST cuts and the consumer space, just tell us why.
Well, I wouldn't say I'm not enthused in the consumer space, because if you look at consumer staples and discretionaries have, I think an outsized impact, as far as the GST cuts are concerned. They are much more price sensitive. I mean, the price elasticity in the consumer discretionaries are way more. We are already seeing that anecdotally in automobiles. So I'm actually quite positive on the consumer discretionary space. It is actually in staples where, the most of the companies, most of the sub-segments are actually very well penetrated in India. And they're trading at humongous valuations. That is where I am a bit cautious.
Okay, all right.
Sorry.
I understood that point. On IT, what's your thought process? And I mean, how are you looking at IT in the traditional sense, IT services, and a lot of these new age companies that have now become part of the listed universe, right? So, and tell us how an investor should approach it. The traditional firms, they do have cash. They're willing to share cash with their shareholders, like we're seeing in the form of Infosys. So do these older stocks still have a tactical place in the portfolio? And on the other end of the spectrum, you have the platform companies, your food delivery, quick commerce, and now urban company, house help, etc. So much more. Where would you put them? And how much would you be willing to allocate to new age tech?
Right. So, again, to answer in a nutshell, in a single sentence, I would certainly be more enthusiastic about the new age tech companies. If you look at the traditional tech companies like the TCS and Infosys of the world, it is very clear that these companies, they don't really have too many avenues to invest the surplus cash that they're generating, and that is why they're resorting to buybacks. No doubt, it's good corporate governance to return excess cash to shareholders through dividend or buybacks. TCS has been doing it for many years. Now Infosys has joined the bandwagon. But it also tells us that the core business volumes that these guys were relying on, that is under threat, either from the geopolitical tensions in the Western Hemisphere or from the threat of AI, which is writing a lot of code. And therefore, this manpower arbitrage model is, unlikely to work for a very long time. On the other hand, the Zomatos, Swiggies of the world, they have a very fast-growing market because despite the growth that they have had in the past few years, there's a humongous amount of space, a very large portion of the consumer which still don't utilize their services. So yes, I think the headroom in that second space, the new age tech, as you call it, is a lot higher.
By the way, the Nifty Bank has dipped into the red. It's a minor 50-point downtick. But from the day's high, it's lost about 220 odd points. And autos have overtaken IT now as the top sectoral gainer. The auto index is up 1%. You've got Eicher Motors right on top. And Eicher Motors this month has added nearly 13%. Tata Motors, Hero MotoCorp, Maruti, M&M, all gaining about 1.5%. So the first 15 minutes have seen autos make a comeback, also buying interest in many of them. Manishi, so in the consumption basket, discretionary, give us subsectors or themes that you like. Is it airlines? Is it the hotel plays? Would it be the travel platforms like your Ixigos and Yatras of the world? Would it be the luggage sectors, footwear? Is it trend and the likes? The themes in the discretionary consumption space, other than platforms, which attracts you?
So there are three broad areas that I would talk about. First, the domestic discretionaries, and right at the forefront are the automobiles, particularly the four-wheeler passenger vehicles, right? So they would likely grow faster than the two-wheelers, even though we are seeing some buoyancy in the rural demand as well. The second area would be the tourism-related sectors, and in that, quite a few smaller subsegments would come in: the hotels, the airline companies, the tourism platforms like you have. So, again, this sector, one would have to be a bit careful about the valuations. And the third, which I briefly alluded to, as the population becomes more affluent, they also become a little more health conscious. And this is not really a tailwind for the pharmaceuticals, but more for the hospital and diagnostic chains. So these are the three big focus areas for me right now as far as discretionary consumption is concerned. And I think they will remain so for the time being.
Okay. All right, Manishi, we will leave the conversation there for today. Thanks very much for joining in. Appreciate you being with us. Have a good weekend, and we'll connect again soon. Well, that's a view from Manishi Raychaudhuri.